I'm here to tell you just a little bit about who are institutional investors, how to get value from them, how to search them and approach them. Well, my predecessor on stage started with a very good presentation on Kickstarter and how to get crowdsourcing to work for you. But actually, I consider investor to be something like a spouse, a partner, like a husband or wife. And well, obviously, a woman can replace a husband with crowdsourcing, but still, it doesn't work always. So I would recommend combining both. So first of all, just a little bit about myself. I'm director and founder of iTech Capital. That's a private equity fund doing venture capital deals, a bit late stage, in Moscow mainly. We've done a couple of deals, all in internet. First one was Pult, which started as a platform for small and medium businesses to automate their search engine optimization campaigns. And now it's third largest advertising business in Russia, with revenues exceeding 77 million and EBITDA exceeding 30-something million last year, which is going to have an IPO on NASDAQ. So, in our track record is successful IPO of Kiwi last year. So it IPO'd with capitalization around 700 million, hit 3 billion last year, dropped a little bit because of, Ukraine stuff and all other political shit. But anyway, good success. So we've done a couple of more deals. Ticketland is ticketing for theaters, concerts, etc. Avia Sales is third largest meta search for airline tickets in the world. MFM Solutions is solution to, send text messages. Icon Text and Garpoon, two largest independent marketing agencies online. Kiwi Post, it's a joint venture with a Polish company, InPost, Paczkomaty. So it's Paczkomaty in Russia, and a couple of more deals. Also, I'm CEO of Pult Group. This is a group including CEO Pult and other marketing assets, and chairman of AdCamp. That's also a supply-side platform, blah, 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 many, many more. So what I wanted to talk about today is what types of investors are there in the field, what values do they usually bring, how to search for your perfect investor, how do they operate, how to understand how they think, and how to approach them and market your company for a successful deal. So if we take a look at investor classification, first question is, why do they invest? It's, the answer is either they want to make more money or they want to make more money, but with different ways. So financial investors want to buy low, sell high, perhaps do something to sell higher. And strategic investors want to make your company part of their strategy. So for financial investors, there are several types. It's private investors, like guys like you and me, who can invest $100 or $100,000 or $100 million per deal. Also on public markets, also on private markets. There's also institutional private equity, which is private equity funds, which includes venture capital, growth capital, etc. Institutional public equity. These are brands like Fidelity, General Catalyst, Franklin Templeton, large funds managing tons of pension funds money, investing in public markets, in public shares. Strategic investors can be split according to what type of strategy they are chasing. So, there are 4 types of strategy according to Igor Antsov matrix. It's either expansion, which is same product, new market. So, for example, if Groupon is acquiring a coupon service in Eastern Europe, it's an expansion strategy for them. Vertical integration is when you acquire your supplier or your customer. This can be done to improve margin sometimes. So it's also a good strategy to be sold to strategic acquirer if you are his supplier or customer. Horizontal integration is same company, reducing competition, making something larger and bigger. And diversification is something new, but it rarely happens. So if we take a look at institutional financial investors, usually they can be split based on which rounds they invest. What is a round? Round is just a situation when the company needs money and attracts it. So different stages, seed or pre-seed is when you got just a bare idea and a prototype of your product. No revenues, no team, nothing. And usually where to get money on this stage, it's like, I've seen people running around pitching everything that moves, like doing elevator pitches, but usually the source of funds for this stage is grants from government or from like different large companies, Microsoft, Intel, etc. Incubators and accelerators, which also sometimes invest. A good example is Y Combinator in Silicon Valley, or a Silicon Valley Bank. Business angels, this is just private individuals who are willing to help your business. And FFF, which is friends, family, and fools. It's like using your own money, using like money of people who just believe, or just using family money. And the size of investment is from like 10 to 500K US dollars. On round day, usually companies still like don't meet the first break-even point. So perhaps first revenues, they need money to expand, to start advertising. They got like their product working, still testing. And this is usually 500K to 5 million based on the region. So it's like usually 5 million in Silicon Valley, 500K in Eastern Europe. But it's done by early stage VCs, that's funds, or same business angels. Round B is usually when your company is rapidly expanding, growing like hell, trying to break even, still not profitable. A lot of like, action is happening around, like, and the founder is the main driver of the company. So this is done by like pure VC funds. It's like 2 to 10 million based on like deal size. Well, it's different in other industries. For example, in like renewable energy, I've seen a venture deal for $800 million. That was a like seed deal. But in medicine is also hundreds of millions. But for internet and internet consumer sector, it's usually the numbers are like this. On round C, a company starts to restructure. It hires a CEO. It starts to become so big it cannot be controlled just by one person or like a team of individuals. So you need to build some sort of a strategy, and to make it transparent for yourself and for your investors and for your like shareholders, you start doing some corporate governance actions, such as like board of directors, like investment committee, something else. And also you are doing your first merger and acquisition activity. You're starting to purchase companies as a strategic investor by yourself sometimes. And well, you got profits, you're paying dividends, you're growing. So on this stage, usually funds like iTech Capital, for which I work, invest. And the average deal size is from like starting from 5 to like north of 50 million. So round D is sometimes called mezzanine financing or pre-IPO financing. It's usually done by private arms of public investors, such as, well, Fidelity and other guys I named before. It's usually done like half a year prior to IPO. They anticipate pretty low returns, like 10% annual returns is good for them, just because they try to choose companies which are likely to succeed on the IPO event. And they usually invest like 50 million plus. The good cases are like Twitter, Facebook, like Shopify. All these companies receive their pretty large rounds pre-IPO. And well, IPO, a lot of startuppers consider it as like end of life. Is something like exit event for them. But well, unfortunately or fortunately, it is never an exit event. So you have to continue growing your company after the event of IPO, and you just as a new status. But being public brings a lot of challenges and a lot of like pluses for your company. So first of all, the value and the valuation of your company is much larger just because it's 100% liquid. So valuation of your company is very, very much dependent on liquidity. So how easy is to sell your company in like 5 minutes, or like how long does it take to sell it? So for startups, it's almost eternity. For a public company, it's just 5 seconds, or like how much does it take to press a button on a PC to acquire shares of Samsung or Google. And also it brings responsibility and limitations, so you can't act freely. You need to think of how everything would influence on your company, and also some, like unpredictable stuff like politics or like geopolitical stuff. Like you can see all the Russian companies on NASDAQ, like Yandex, Mail, or Kiwi. They dropped dramatically, like 30% after like political stuff with Ukraine, but no one cares on IT and internet about like this sort of stuff, but well, still it influences on your company's values, and this is really bad. So what values do they usually bring? Like if we take a look at institutional financial investors such as venture funds, first of all, they are outsiders to your business, and they got a lot of experience and wisdom. They survived a couple of economic downturns, like credit crunches before. They know how to plan, how to budget, and they know what to do if something goes wrong. And it's usually good if someone has like the other point of view. I know a lot of entrepreneurs who are scared that, like an investor will come and he'll just have another point of view, he'll try to persuade you, he'll just be bad for the business. Well, it's not. Like when you have a discussion, not perhaps an argument, it's just helpful for the business. Second is these funds do not manage the business, so they are just nothing to do with operational control. They just want to help. I could say that they are like passengers on the back seat of your motorcycle, so they might help when you're turning. They have like a fuel tank in their hands. And they can like kick you in a helmet if you're doing something terribly wrong and if you are going to kill both of you. But they do not control, and they want like the company to be transparent to understand what's happening inside. And this increases overall liquidity of your business dramatically. So it makes your company easier to be sold, and thus it makes it more valuable. So also, brand name, reputation, introductions works really good just because like institutional investors are there for ages, for perhaps tens of years, and they can help you roll out to the market faster, find some like acquaintance in other markets, set up business operations in externally, and might also be good. Also, they can bring some research and legal support just because they got usually pretty good access to like legal stuff, their own legal stuff, or outsourced. Usually the funds can bring you better prices on like consulting, audit, and legal support just because of the bulk of their orders to these companies. And also their analysts are ready to help you all the time. And once you got an investor aboard, it helps to like market your company further because they want to exit. The only point for them, if it's a like proper investor, not like an oligarch or something, or like a bandit, if it's a proper investor, the first thing they want to do is exit from your company, like to make money on exit. So they help you to make your company more noticeable on the radar of larger funds, of larger strategic investors. And if you take a look of like all the companies purchased by large strategic acquirers like, well, whatever, Amazon, Facebook, Google, most of them, like 95% of them, were venture-backed. And we've got a research which indicates that if a company is venture-backed, it's usually costs more to the strategic acquirer to purchase it just because the investor does a lot of marketing and sales activity. So, well, yeah, and some money as well. They give you money. That's the like primary source why you start to search for investors. But like approaching funds is like approaching women. So they got their own life cycle. They got their own cycle. So you need to watch for periods. And make sure you're not hitting on the fund when it got periods. So usually the funds in IT sector, yeah, well, we've got just one woman in this audience, which is good. Otherwise I get like, yeah, tomatoes flying into me. Okay, so funds got their own life cycle, and usually they are like 5 to 10 years old, and then they just disappear. So how does it work? A lot of like LPs, investors, different institutions just collect their money, put it into one sack, call it a fund, and then after like 5 to 10 years, they want it to dissolve and get their money back. So the same as investor wants to make exit from your company, like his investors also want to make exit from his company. So, but it happens usually like after several years. So if it's a 7 years fund, first 2-3 years they are actively investing, then they are doing actually nothing in terms of like investments or divestments. And in the last like 4 years, they are trying to do as much exits from their companies as possible. Especially large private equity firms, they usually tend to run several funds with different life cycle. For example, if we take Sequoia Capital, they got like 4 funds working at the same time, each one on different life cycle stage, so they can invest all the time and they won't miss any opportunities. But anyway, if you are meeting an investor, think on which stage of life cycle he is, and like what does he think? For example, his new fund, which is actively investing, is much smaller and has a like strategy for investing in big data. And your project is nothing to do with big data, but the fund they got, which is larger and focusing on your sort of companies, is already like on being dissolved. So, it's easy to understand that it's nothing to do with this fund. You can't proceed with the deal, and you're just wasting time. And if we take a look at like average deal life cycle, a lot of entrepreneurs think that like deals take 1 month, several weeks. Well, my personal record is 3 weeks, but it's something outstanding. I've never done like a deal faster than 3 weeks. Well, I've just done a 3-week deal one time, and it was a Series A deal, so pretty early. Usually, initial review, when like you meet the fund, you talk to them, you get to know them, you understand if you need the fund, and the fund understands if they need your company. Takes just 1 month, perhaps a little bit longer. Then they need to perform due diligence, which means that consultants will land into your company, will dig into your finance, dig into your documents, understand what the risks are for the fund to invest in your company. It also takes from 1 to 3 months. And also the process of signing the deal, preparing the documents, writing the shareholders agreement and share subscription agreement, and all the option agreements, and et cetera, usually takes time. So average time frame for signing a deal is around 3 months. And then 1 to 3, perhaps 5 years, the fund's on your board, it's your partner, it's your spouse, you can rely on him, they can rely on you. Sometimes, well, you might have conflicts, but well, as I've said before, having arguments on the board is good, just because you have like all types of views on your business, and it helps like take strategic decisions properly. And then they exit, so the fund usually gets an investment bank on board, so they can help to sell the company or to attract a new financial round, and then the transaction the same, 3 to 5 months for the transaction. So what to know when you're approaching and searching for an investor? Pitching anyone passing by is obviously not good, just because, well, it's sort of a like flash sale. Your company is not like a good for a flash sale. It's not like Christmas fair. You have to sell it exclusively. So do some proper homework, do some research. First of all, get your investor deck done nicely. Get like a financial model, like a forecast for your like future incomes. Try to do it like several scenarios: pessimistic, optimistic, like realistic. Get a presentation, not long, not dull, just like 3-5 slides is okay usually, and write an email, like write a cover mail. Then choose possible investors by country and industry. Usually, if you Google, you can see like a lot of like lists of investors or like investors A to Z or etc. for every country. Just choose those who invest in your country and the like country where you're doing your business, and those who obviously invest in your industry. Just because, well, approaching an oil and gas fund with a like social network is a bad idea. You're just wasting your time, wasting their time, getting 0 results. Then filter the list you got by investment stage. So if you're a seed stage startup, it's also useless to contact Sequoia Capital, larger fund, or like Summit Partners, or anyone who invests in later stages. If you filtered it and you still got funds which you might like for your company and which might invest in your company, take a look at their portfolio. It says a lot about their funds, because usually funds have their sort of a character. While in people who work in the fund usually also have some sort of a character approach to investments. For example, if they have just e-commerce, perhaps they just understand e-commerce deals and they don't invest into media or advertising. Or they might have like a major part of their portfolio in advertising or media, and perhaps it means that they don't want to mess up with e-commerce. And also, it gives you idea how they can help your business, because, well, if they have invested like 5 times in social networks and they've done 3 exits from social networks, first of all, it means that these guys know how to do that, and these guys know how to sell these companies and know people in the strategic acquirers. Because, well, you know, when Facebook acquires something or Google acquires something, it's actually not Google acquiring something. It's someone inside Google with his own motivation, his own ambition, his own character, is signing a deal and selling it on their board of directors and being an internal ambassador of the deal. And it's not the company, it's just one person. And if your potential investor knows him and knows his motivation, it makes it much easier. So, come on. When you found like a list of 3 to 5 investors you might like, which also might invest in your company, and you like their portfolio, you think it's likely that they invest and they like your industry, ask someone to introduce. Like, it's the best way in all the countries, especially, well, China or Russia, Eastern Europe, but also it works in the West the same way. Usually you can find someone in the market who knows these investors. Well, sometimes you can't, so if it's impossible, track them on conferences. Take a look at like different conferences at the speakers of the events, go there and just catch them after they speak. Or if like the time is limited, there's one trick I can tell you. You can just email out of the blue to any investor, like check if you check like which conferences he attended before, and saying, "Hi, we met on Infoshare 2013," or like any other conference. Because he would never remember whom he met like on the conference before, so it's a good way. Hey, we know each other, like I've got a project, so take a look at my presentation, please. But it usually works good if your email is like, you know, conscious. If you are not an U4 guy, sort of like alien. So try to balance between like creating an auction, like a flash sale, and between future zoo on your board. It means like investors really like to share risks, so they really like to form consortiums. Like 5 to 7 investors per one deal is a very common situation for Silicon Valley. It's pretty rare situation for Eastern Europe though, so try to balance, because like having 10 investors on your board on Series A brings no value, just because like for example they got 25% stake for 10 investors. It means like average stake is 2.5%. No one would be committed to your company. No one from the investors would feel their duty to help you. Yes, it's, well, good, you got money, you got no influence on the board, but anyway, you got no value. So try to balance it, like balance the number of investors, the stake you are selling, and like the amount of attention the deal gets, because you don't want to get too much attention. Well, that's pretty much all. We've got 5 minutes for Q&A. Are there any? I'm sure there are. Yep, I can't see any hands.
Czy są pytania?
Yeah, well, looks like
Okay.
you got it. So I'll just talk about Russian investors for 5 minutes. So if you can see what's happening now geopolitically, it's pretty clear that money is flowing outside of Russia, and it's a very good opportunity to go and pitch Russian investors. All of them have international experience, all of them have good connections in Silicon Valley, And like if we take Almaz Capital, Runa Capital, iTech, most of them have their offices in Silicon Valley or like done pretty good exits to Silicon Valley companies before. Some of them got good offices for like Southeast Asia expansion, and they got money. They don't want to invest in like few Russian assets working on Russian market, getting their revenue in rubles so much as they did before. So like if you are eager to get like an international approach, some outsider to help you get like argument on the board with helping you to bring strategy, try to take a look at Russian investors because of the, well, that's a good situation, is a good vintage point to get some smart Russian money on your board. So thanks a lot for your time.